Good day traders, Stacey Burke from Stacey Burke Trading. Today we're going to be going over identifying potential institutional buying and selling levels that may coincide with some of the methods you're using to trade the markets, and obviously helping to identify higher probability areas for buying and selling along with what other methods you're using to trade the markets. We've talked about the market maker template or the weekly template, trying to identify if you're in a up template, a down template, or a side ranging market, but also looking at certain specific times of day for when the market may present you with higher possibility opportunities in terms of asymmetrical risk reward. One of the things that we've been through in some of the previous videos is looking at the market to identify if you're in a up or a down template. Now, last week, obviously, if you're looking over the last 3 to 5 days, you can potentially identify if the market was down or up or in a sideways market. And today, just looking at the pound, we can see that the market clearly was making lower lows and lower highs throughout the week, and then heading into the Thursday, Friday, the pink line is our Monday. The Thursday, Friday, we started to see evidence of a possible reversal day forming as our midweek reversal to come back up towards the weekly high. We did not see that eventuate. But one of the things that I go through each day is before the market opens, in terms of the London market, I will look at levels on my sweet spots indicator, which I will include below, and also the iSessions indicator I use to set my blue box to give me an idea of the Asian trading range from the US close into the Asian hours. And just for a lot of the people that have messaged saying these boxes don't make sense in terms of Forex overlaps, it's 24 hours a day, all that stuff. These time frames are customizable, and I customize them to what I want, and that ends at 2 a.m. New York 2 a.m. New York Eastern Standard Time for me. So I look at the close of the market and how did the market close as it headed into the Asian market, and also where was our last, in a downward move, I look at where was the last swing high, and that becomes my new initial high of the day target. But I specifically look at the levels. So if we look again at the sweet spots indicator, if I bring that up, and again, I'll include that below. I've just set mine at 100, 100, and 250, and I've changed the color to red. That's just what I want. And so that helps me identify every 100 pip level, but also the 25 pip increment levels. And I expect to see a 50 pip range set up for me to trade from. So again, each day I look for some evidence of when the market closes of where that swing low may be in terms of the down template, and then I may even measure in my head 50 pips roughly, what level does that take me up towards. And as we see markets head into the Asia close, we may see evidence of that box forming or stalling at a previous level that was once maybe support, which is now potentially became a supply level. And that's what we're trying to identify, is where are these high possibility zones off of institutional levels where the institutions may indeed be building up positions. So we see that as the market moves sideways, and as we went into the Thursday, Friday, the market was selling off from the 30.25 level each day. So they've enticed retail traders short, then stopped them out or put them under pressure if they didn't take profits up top, sold it off again, went into our Asia box on Friday, pushed that into the double zeros. Traders traded that long to the high of the day, were vectored again or had high momentum movement back down to stop them out. They pushed it back up in gain to take out the previous day's high, trapping breakout traders long who would have definitely had stops placed below Thursday's bar, and then sold it off again into the close above the 30.25 level. Now, as the market traded on Monday, we see traders taking short positions at the initial high of the day, back into the double zeros, double zeros with a 3 push movement. That first box of Asia is our first level of trade. 2 pushes up, 3 pushes back into the peak formation, which if we spread this apart for those traders who are still struggling a bit with the M and W, you can see the M formation into the US close. We'll just put a little thing right here. You can see the M pattern. There's the middle of our M, and then it auctioned off down back to the double zeros. It gapped on the open, pushed sideways again above the double zeros into that level with a 3 push pattern to sell off. So again, it's stepping back and looking at, again, if we measure this, we're looking at roughly 50 pips from the low of the day to where that selling level was reached from Friday, and then the market ran straight through these levels that had acted as light supply levels, which were designed potentially to entice more retail longs, weak level longs into the market. As we headed into Tuesday's session and the market has pulled back and consolidated into the Asia low, we can see that that is now, which was support last Thursday, is now acting as a potential selling area just below 29.75. The market came right out of into the Europe Open and immediately took out the day's low. Now for breakout traders, that's something to think about. Paul Tudor Jones made a quote one time. He said, if the market's trying to go in a certain direction or giving you an indication that it's going in a certain direction, don't try and fight that, trade with it. So we see that we were in a down template. Traders were looking for that reversal long. We didn't see that happen. The markets made new lows on Monday, pulled back into that supply level and broken the Monday's low into the Europe Open, and then auctioned back up with a 3 push pattern again, which into that 29.50 level. So where sellers were coming in just below 29.75, once the markets dropped down, that selling level from the Europe Open, so Europe Open, the Europe high is here at 2 a.m. We now see sellers above 29.50. So again, institutional selling potentially happening above 29.50, and this is where the 12 candle rule comes in that I talked about before. If you look yesterday's on Monday's trade, that market built up until the US pre-US Open, and then the US Open it sold off. Yesterday's trade again took longer than the 12 candles, but heading into the pre-US Open gave us our selling level and also an M pattern at the top of a 3 push pattern into a sales zone at 29.50. That market didn't quite get down the full 50 pip range, but we have roughly a 50 pip range of movement from high to low of the market. Now as we head into Wednesday's trade, we don't really see any evidence of a reversal day as of yet, and based on last night's US close, we see that there is sellers above 29.25, potentially from previous price action to the left. We see that there is demand below the 2900 area, depending on how that behaves today as we head into the Open of London. Will give us a better idea if this market is potentially going to be hitting a reversal between today and tomorrow and into Friday, or if this market may continue to sell off and push through that demand area. Now, we haven't really seen this market pull back from yesterday's low. It's just continued down, so I wouldn't be surprised to see this market push a bit lower before it pulls back, either in a reversal format with a bit more aggressive movement from side to side as we saw last Thursday and Friday, or if we may just see this pull up and then again resume the downtrend with that 29.25 area acting where it acted as support yesterday, potentially acting as a selling area today for institutions. If we go to the pound yen, again very similar. Get in the habit of marking these levels off and just keeping notes for yourself. If you're not fully understand that, but you want to start to identify potentially, what I look for is a 50 pip range between selling and buying that I can identify. And again, in a down template, we saw the market take off right off the bat yesterday and go from 4150 above the 4200 area before it pulled back, which was 50% roughly of the Monday's range exactly. And so we saw that market selling off above 4200, which again, if we go back, we see that the 4225 level acted as a demand level last week. And as that down template continued, we saw the market auction back up to test that area and also witnessed selling off into the Europe Open. So we saw this market just push straight up. We don't know if that's up or down. Then we see the market sell off. So we know that they're selling above 4,200. We're in a down template. We have now a geometric range between the top and the bottom. So we redraw our levels between 4175 and 4200. The market then again pushed up with a 3-push pattern into the pre-US Open. It gave us a reversal off of that 4200 level and then straight down 50 pips to where we've gone sideways. So we do see that there was evidence down here of some demand below 4125, and again based on last night's sell-off into the US close, we see that there was sellers above the 4175. Now depending on how that behaves coming out of the Asia consolidation today will give us a better idea if we're going to see a reversal setup or if the downtrend will continue. So I'm not afraid to trade off of either one of these levels, but I do want to see a 50 pip spread in there, and I want to see evidence in terms of candle confirmation to be able to buy off the bottom or sell off the top. I don't just sell or buy off of these levels. I just identify them as institutional areas for selling and buying. And again, this is sort of something that you want to get in the habit of. So we can see that Tuesday morning, this is people have questioned, they might just blindly sell into a level, a support or resistance area, but the market went straight through that. There was no evidence of that acting as any form of selling whatsoever, and that's what you want to be looking for. You don't want to just pick a level and blindly sell off of it. You need to see evidence of selling take place and then a retest, or buying take place and a retest, and then candle confirmation or price action that supports a reason to sell or buy off of these levels. So again, the sweet spots indicator helps me identify these 25 pip increments and then double zeros. And when you get into these Monday, Tuesday, we're into day 3 now. So at this point, I don't see any evidence of a midweek reversal forming. At this state, I'd still be sticking with the downward template. So regardless of how this comes out of the consolidation in Asia, I would still be looking for evidence to sell high in the downtrend. But if it does come and give me a candle pattern to buy low, I would be willing to take that. But again, at each price level, I would be looking for any reason for that market to take profit, unless the market moves strongly right through a level or through the initial high or low of the day. So hopefully that helps traders. Again, I'll include those 2 indicators below for you to help set up on your own charts, but get in the habit of identifying where you can see the selling and buying levels occur, and you can also see that on these charts why technical indicators will often take traders in the wrong directions of these trades, because a lot of these swings are designed to trigger technicals, but also when they break through support and resistance levels, it also triggers breakout traders into the markets. Pay particular attention to daily high and daily low levels. They will often give you information that will help point you in a direction of where the market's heading. So hopefully you got some value from today's video, traders. Stay disciplined, stay focused. And just one more note on that, you can see that regardless of where you may position yourself into the market, if you're getting in at one of these levels, why your stop loss should very rarely, if ever, be greater than 20 pips. These ranges are 25 pips, so if you're positioning yourself in here, I like to try and keep my stops to around 15 pips. Sometimes if my fill is not the best fill in terms of price, I may have to open that up a little bit, but I'll adjust my position size accordingly. And again, I'm trying to usually target at least 50 pips. If it's a counter trend trade, I'd be looking for something or some evidence of that to be failing at a 25 pip increment level, unless the market moves right through it, as we saw yesterday in the open of the Asia session. So stay disciplined, traders, stay focused, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.